And once, Trump's in office and we actually start to see some of this stuff play out, like the first 100 days, I'm sure is going to be just madness. So things will happen quickly. And I think I would expect that they'll probably change more to the upside in the first 100 days.
Hey everyone, this episode is brought to you by Uniswap Labs, who is launching the largest bug bounty program in the entire history of crypto. It's a $15.5 million program. This is aiming to be the most rigorously reviewed code base ever deployed to Ethereum. So if you want more eligibility on the scope, rewards, payouts, etc., just click the link in the bottom of the show notes, tell them that I sent you. You'll be hearing all about Uniswap Labs later in the program. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another Roundup edition of Bell Curve. This is the first one of the new year. You got Michael's 1 and 2 and Vance. Fellas, welcome. And before we get into it, I want to give a super quick shout out to this episode's sponsor, Aave. Aave is one of the oldest and most trusted protocols in all of DeFi. They've got $20 billion worth of TVL. So whether or not you want to swap, lend, borrow, whatever you want to do, just click the link in the show notes, head over to Aave, tell them I sent you. And guys, welcome. How's the new year getting started for you?
Happy New Year, everybody. Thanks for listening in. It's going to be a great year. No matter what the market says, it's still going to be a great year.
I mean, we're both a bit sick somehow.
Yeah, same.
I feel like everyone I know is sick right now, but ready for 2025. Feel pretty relaxed from our kind of vacation. I think it's the first time we've taken really like a week or two off, definitely in 2025 or 2024. So yeah, I'm feeling ready, and Orange Man isn't even president yet, so there's a lot to look forward to.
Yeah. Can I ask, how is everyone sick right now? I was in Zermatt over the holidays, and I'm sick. Everyone there was sick. When I got back, everyone in New York is sick. And yeah, you guys, Michael, you're in Hawaii.
I was in Hawaii. Everybody got sick there. There was something going around for sure. And then Vance and I were in San Francisco this week. And Vance comes in and immediately I'm like, I'm not feeling super great. I think I'm getting over something. 24 hours later, Vance is like, I got what you got.
But we battle through it for the Bell Curve Chads. Always.
Always bringing you guys content. So what's also, before we get into the crypto stuff, very sad story. So, I mean, you guys are relatively close to this. Like, what's going on with the Palisades? I don't know. It's like the craziest thing I've ever seen, just the amount of fires going on over there. What happened?
We've just had Fox LA on in the background yesterday and last night, just trying to get updates. I mean, we have friends. So Vance and I previously lived in mostly Venice, but obviously have a ton of friends in LA and all over Palisades, all over, Hollywood. Vance used to work at Netflix, which is right down the street from where that Hollywood fire started last night. We have really close friends who lost their houses in Pacific Palisades. We have friends who live in Santa Monica and Venice who are like, should I leave? Should I go? I've got, 5 or 6 refugees that are in my house and staying here, but now we're deciding whether or not to go. It's pretty gnarly. It's going to be something that takes a really long time to unravel. I hate to compare it this way, but I think the only fair comparison is something akin to what happened in Maui a couple years ago. And it's going to take years for that area to redevelop. There are thousands of structures that have burned, and this is some of the most expensive real estate in the world. And assume that, now there's all these questions as to what do you do? There are 1,600 State Farm customers in Pacific Palisades alone that lost home insurance in 2024. That's one insurance company. I'm sure that that's multiplied over basically every major insurance company. The question would have been, okay, do you take the insurance money and rebuild, or do you take the insurance money and go somewhere else? What if there is no insurance money and your house just burned down? This is going to be a really, really big disaster for California and Southern California. And frankly, I mean, it's up there. We were also looking at just what are the largest from destruction of value. What are the largest natural disasters? They're basically all hurricanes, but Hurricane Katrina was 183 billion in 2005. So, adjusted for
Wow.
inflation, let's call it 250. That's, given all the things that have burned down so far in Palisades, if thousands becomes 5,000 structures, you're talking about something that's not, and it's $5 million on average per structure. You're getting pretty close to that number. So this will be interesting to track.
Ugh. Woof. Well, heart goes out to anyone that was impacted by that. I saw this guy, Keith Wasserman, got absolutely torn to shreds on Twitter. I thought it was a little unfair. I mean, he was just saying, hey, is there anything that anyone can do? I mean, obviously.
No, there's not. You're just supposed to die and then blame climate change. It's like
Yeah.
what comes next is now kind of this tension between, you saw Bernie Sanders tweet, this is just climate change that did this. It's like, may have been the homeless people lighting trash fires in 60-mile-per-hour winds, but we can call it climate change. And so I think there's that side, and then there's the side of like, what the fuck happened? And there's this guy, Rick Caruso, who ran for mayor and lost, and I think a lot of people are now wishing that he won, who's saying, there was no water in the fire hydrants, there was no brush clearing, there was no forest management, there was no all of this stuff that you should think is just, very natural. And there's a Joe Rogan pod from like a year ago. I don't know if you saw the clips of this where he's like, I talked to this firefighter and he's like, look, certain point there's going to be the right winds, the right humidity, and there's just going to be the right fire starts in the right place, and it's just going to burn down the whole city. So to say that this is
The
not
literal quote, which is a little bit eerie, from July of last year, was, if there's a fire that starts in Hollywood, it'll literally burn all the way to Santa Monica without us being able to stop it, which, if you understand the geography of LA, is literally what just happened.
and the Palisades is one of the nicest neighborhoods in LA, and like I've rented a house there at least one summer, and like it's like you couldn't even imagine a fire ever touching it. But I mean, what's interesting, kind of tying this back to crypto, is I mean, Michael and I are both homeowners, and you think about a home and the price of a home, and it's the price of the home and the real estate and the land and the building, but there's also the property taxes, there's the insurance, there's a significant carrying cost that's associated with real estate, and there's also interest rates, right? If you have a mortgage, that's another carrying cost. And so you think about the carrying costs of real estate, property taxes going up, insurance sure as fuck is going up a lot, interest rates probably not coming down. And so like, for me, I think one thesis for crypto is like maybe the physical asset market cap has forever topped, just because these carrying costs on physical assets that used to be so low are going significantly higher. The carrying costs on digital assets are zero. And it's like, I'm thinking about getting another place, and it's like, do I want to buy it? Do I want to rent it? Do I want to like, own this thing that has, burn down risk, earthquake risk, all this high sorts of carrying costs. And this is going to be a watershed moment for the insurance market, especially in California, where the cost to have a house here goes significantly higher. And with all assets, the higher the carrying cost, the lower the price.
And just to add more color to that on the carrying cost side, the reason why specifically State Farm dropped 1,600 Pacific Palisades customers last summer is because there was a California state law that was attempted to, I think either it passed or it didn't pass, but basically what it enabled or what it pulled back was the limitations on how much you could raise insurance premiums on home ownership, and it capped it. And basically, State Farm said, if you want us to be able to, if you want this cap to be in place on these insurance premiums in high risk areas, such as Palisades, such as, Napa had a fire a few years ago, any place that's in a more rural landscape, even if it's suburban or, even slightly metropolitan, but it's close to something that has the potential of a fire risk or natural disaster risk, they're not going to be able to insure it anymore if they're not going to be able to price it properly. And so what they're going to say is, it's just, you can't buy home insurance anymore. Like, I have a place in San Francisco. You can have fire insurance in San Francisco because most of the buildings are up to date. They're now earthquake safe. Like, it's a very different environment than rural Napa or rural Palisades. But you can't get fire insurance in Napa. Period. End of story. And so what do? Do you just own the house? I mean, that's the other part of the carrying cost is your choices are, you can't get it and you buy the house, or you don't buy the house. And if you buy the house, then you run the risk of like, okay, well, what happens if fire rips through? however many $1 million house is basically just like a potential loss completely.
And this is the bull case for digital assets as well. It's like, okay, let's say you're a millennial. Let's say you worked at a tech company for 5 years in the Bay and you've got $5 million. Do you go buy a house in Napa that can burn down and go to zero and has significant carrying costs, or do you buy stocks or digital assets or other stores of value that will persist? Like, I think the answer to Michael's question of like, what do you do if you can't get fire insurance is like, that house in Napa probably needs to be half the cost for that to be worth it for me. Like, yeah, I'll take a punt on a Napa house, but like, I need to be priced right for it to burn down, basically, which is a crazy thing to say.
Yeah, I don't know if it's half. I don't know if it's a third, less or 20%. Like who knows? But basically, where you used to be able to cover the risk, now you can't cover the risk, so that should be affected in the price. The other angle here is, I think that we're going to see a larger generation. This is kind of combining all these points. A larger generation of younger demographics who don't want to buy, but want to rent, and because you don't have the carrying costs, or you don't have the equivalent expenses that pass through. But I also think there's going to be a new asset owner. So instead of you buying the house in Napa and being able to go and visit it whenever you want and have friends over, blah, 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 there's going to be more longer term operational use opportunity. And so it'll be a corporation who buys a bunch of vacation homes, and it's like a shared model where you don't actually own the home, but it's a corporation who pulls everything together. Like there's potential for new business model on changing preferences of renting or leasing or short term use versus long term ownership of physical assets for this reason.
The last thing I would say is like the insurance markets in California are such that many of the private company insurers pulled out last year or over the past few years because California has to give you permission to raise insurance rates. And so many of them just said, it's not worth it. Fuck it. Like, we're just going to cancel our coverage. And so the uninsured portion of that falls to the state. And, today they're looking at probably minimum 10 billion of insurance losses. And the state has $100 million in its coffers to cover that expenditure. So like, they're off by several orders of magnitude. And, how they plan to fix it and refill those coffers is they're going to say, any insurer that's in California, based on your market share, you are going to pass through a surcharge to your customers. And so like insurance rates are going to go even higher, and potentially even, I don't know if the insurers have to pay, but some of them may even bail on that. I would say there's now like a probably 10 to 20% financial, not maybe regional crisis risk, but like municipal crisis risk, where the insurers just get blown out. And like, if you think about all the things that could cause the Fed to panic or cut rates or like do any of the easing, this is one of them. Insurers are hugely capital intensive that benefit from lower rates, and they're going to need significant help to cover all the costs outlaid from this.
Yeah, this is the case across every single natural disaster zone. Florida with hurricanes,
Florida, yeah, right.
Ice storms in Texas, even a few years ago when that happened. Like, as climate change becomes more climate variability, the ability and the models that exist for pricing in the risk of these physical assets are going to have to fundamentally change.
Mm-hmm. Yeah, and it's a weird. There's insurance markets, there are reinsurance markets, and then ultimately sometimes the government has to step in. And when the government steps in, it starts to look more like a bailout, and it's politically complex. So yeah, it'll be interesting to see what ends up happening there. But we should probably pivot a little bit into crypto here. This is a California podcast now. But actually, it's been a while since we've been a macro pod, and it probably does make sense to touch on the macro a little bit because it seems like that's what's driving a touch of the sell-off. So we had, it seems like inflation is coming back into focus at least a little bit in this last round of Fed minutes. And so the Fed has decided to, they're jawboning in a little bit more of a hawkish way than they were. And now there's a pause in effect for rate cuts. And so over the course of the last several weeks, we've shifted from 7 cuts being priced, I believe, in 2025 to now about 1. And you can see long end yields are rising again, and people are kind of looking at this 5% level for the 30-year. And so that, plus a combination of a stronger dollar, is just putting a little bit of pressure on the economy. And one thing that I've seen people start to debate again, this was coming up in like Q3 or Q4 or Q4, sorry, of this last year when Trump won and he had these tariff plans, is the Fed going to be worried about tariffs and actually be a little bit more hawkish on rate cuts than they otherwise would have been to combat the tariffs? And Jerome Powell hasn't come out and explicitly said that, but I think that's sort of the concern that's bubbling up in macro land and maybe translating into the sell-off in risk assets generally, but also crypto. I'd be curious, like, how are you guys interpreting everything that's going on in
I
markets?
mean, just to like the basic understanding right now is, to your point exactly, there is no micro, it's all macro.
Yeah.
Like, it's happening. Everybody's coming back from vacation. There aren't any major announcements, major changes, upgrade. Like, there are announcements, and we expect in the next couple of weeks, like long-awaited mainnet launches are going to be happening, et cetera, et cetera. The industry will kind of have moments of clarity and excitement, but right now it's just like everybody is riding the trend of whatever macro is delivering. And I think, December 18th with the FOMC notes was pretty hawkish, which was a surprise. I mean, everybody expected 5 to 7 cuts. Now it sounds like 0 to 2, but probably 1 is the most common. What this means, though, is that the market is basically pricing in all of that hawkish perspective since December 18th to now. And December 18th, remember, we were at like, I think 103, 104. Now we're at like, I mean, as of right now, it's like 92, 93. It's had to take its shellacking pretty heavily. But PMI came out a couple of days ago that was higher than expected. There are kind of signals that inflation is going to be stickier, and it's probably going to take months to quarters for it to actually get to a low 2%, if that's still the target. But I think broadly, the way that we're thinking about it, or at least the way that I'm thinking about it, is you've priced in all of this. So you priced in kind of all the market narrative. Where does that leave us? That only leaves us with upside potential, because right now there's one cut that's priced into the market right now. What if there's 3? What if there's 5? Upside potential. What if inflation is at, the Cleveland Fed nowcast has the next inflation target at like 2.8%. What if it's lower than that and inflation comes down faster? You've got like uncertainty around tariffs and like rumors of 25% tariffs being imposed on, Canada and China and all. Like, that's going to drive inflation. What if it's not? And what if it doesn't? Like, there's a lot of, I'd say, downside risk that has now been priced into the market, which leaves the potential market positioning to just have upside potential. And that's broadly how I would describe kind of like where we're at. 2 weeks, whatever, 12 days from the inauguration, like, nothing's really going to happen, I think, until now, from now until then. And once Trump's in office and we actually start to see some of this stuff play out, like the first 100 days, I'm sure is going to be just madness. So things will happen quickly, and I think I would expect that they'll probably change more to the upside in the first 100 days.
Yeah, the other stuff I would add is Scott Bessent has laid out his framework over a series of interviews for how he plans to basically accomplish Trump's goals. First thing he's going to do is deregulate the banking sector and allow them to buy more treasuries so that they can absorb more of this debt. That'll bring down rates. Second thing he wants to do is some sort of like Trump Plaza Accord where he devalues the US dollar against specifically the Chinese renminbi. And then the third thing, he's just like, look, we need to cut rates aggressively. So like everyone is rowing in the same direction. And the stated purpose of all of this is like, let's get rates lower, let's grow our way out of this deficit, and let's term out the debt once rates are low enough. Like, that's the big thing that he's trying to do. But you don't want to term out the debt if the rates are at 5%. You want to do that when they're like 3-4%. So I think the dollar is so high and the 10-year is so high that like the last time they were at this level, crypto was probably a fourth of the price, a third of the price. ETH was at 1,200, 1,300 when rates were last at 4.7 or 4.8 during the Ukraine war, started to pop off. So like, there's just so much juice that we can put back into the system. I think people are going to be really surprised at how this year turns out. Just because it's gotten off to a little bit of a bearish start, I don't think that means much.
I mean, one of the questions that I heard on a different pod was like, where are we in like baseball innings wise in this cycle? And everyone's like, oh, we're in the 8th or 9th inning right now. Like, I don't know what the start was, but in my mind, we're probably looking at just like during calendar months wise, we're probably looking at another like 9 to 12 months of fundamental positive catalysts from a crypto perspective, from a macro perspective. But the thing that I keep coming back to is I think it's going to take longer than people expect. It's not going to be this like massive pump one week and like, boom, okay, that was your shot. Oh, you missed it. Okay, well, better luck next 4 years. This is a slow rise. It's going to take longer. And keep in mind, everybody, the back half of this year is going to have a market structure bill that fundamentally changes the landscape and prognosis for this industry. That I think alone, let alone the macro stuff that's going to happen in the first half of the year, I think alone the back half of the year and the market structure bill will be something that breaks the 4 year cycle for us.
I was listening to the Blockworks Empire pod, I think, and they were all giving their predictions, and it was like, we're going to 125 end of year, bros. Dream bigger.
Who is that? That's Santi and Yano? Said that?
No, I think it was a gang of like the analysts. I forget who.
Oh, okay. Maybe that's 0x research. But yeah, I'm not sure. I mean, I think the other thing too that people, I don't know. I mean, I think it's increasingly less useful to ask where are we in the cycle. That was the question that's literally launched hundreds of podcast episodes, and I'm just not sure that that's that useful of a framing anymore.
You know, it's been great for media. I don't think it's really going to be great for analyzing.
When BTC is at 200 and ETH is at 10K, like I think you do have an argument that like these cycles are going to be a lot longer and probably more muted, but these ETF inflows are still a relatively new phenomenon. They're picking up day over day, and again, it's like the debasement trade is on. Gold is doing very well. Bitcoin will follow that. ETH is the other kind of big crypto asset that people know and is a blue chip. And I think the rest of the field is going to be more kind of like cycle resistant in some ways, where it's just going to be more of like a venture market and not like just like private to public, but like new categories, new themes, things that are buying back their own tokens.
All right, everyone, listen up. Like I said at the top of the episode, Uniswap Labs is rolling out the red carpet and launching a $15.5 million bug bounty. This is the largest bug bounty in the entire history of crypto to anyone that can find a critical bug with the Uniswap v4 protocol. This bug bounty aims to make it the most rigorously reviewed code base ever deployed to Ethereum. Now, the Uniswap name is basically synonymous with security. $2.4 trillion in cumulative volume has passed through Uniswap v2 and v3 without a single hack. So Uniswap v4 is dedicated to bringing that same level of security and transparency to the v4 protocol. So if you want more information or eligibility or scope or rewards or payout or any of that good stuff, there's a link in the bottom of the show notes. I highly recommend that you stop listening right now, go to the show notes, click the link, head over and tell them that I sent you. Start earning money today. What do you guys think about the influence of AI here, just on the stock market in general as well? And I feel like NVIDIA has become this massive bellwether for just risk assets, but now the S&P and the economy in general. And I think there's a lot of focus focus and attention being paid to NVIDIA. And we've obviously seen the rise of these AI agents and this whole new AI meta. And Frank, I'd love to get your guys' opinion on all of it.
Here's a crazy stat. The expectation is that there's 5% GDP growth over the next 18 months. So it's not 5% per year, but you can assume like basically 3%, 3.5% growth. And that in the next 18 months, 7.5% of that growth is from net new AI revenue. That's a crazy stat. And we haven't really gotten there in terms of other industries. I mean, the only one that's really comparable is the forecast. And this isn't like asset value. This isn't like, oh, it's a bubble from, the stock market in 1999 or like the real estate bubble in 2007. This is like GDP measurements and revenue and products that are being purchased. And basically the reason is because every technology company who over the last decade has just been printing cash, Apple, more money than God has been like the narrative. They even have their own hedge fund that literally just does management of cash, and it's based in Henderson, Nevada. And it's just like, how do we manage? Apple does. Apple has a $250 billion cash only hedge fund within Apple that's like treasury management. um, not. I used to work in the finance department there as an intern in 2011, and pretty crazy. But the imagine that all of these companies who've just been stacking cash over the last decade or two. It's like, okay, what do we do? We've been waiting for this moment to invest, and they are buying anything and everything they can from an infrastructure and AI perspective. And most of that's been flowing to Nvidia. Some of that's going to start flowing to others. But you also now have consumers and 150 million or 120 million daily active users of ChatGPT. What happens when that goes from $20 a month to 200 a month with O1? Like the business metrics here for AI, I think will be the thing that also pulls crypto in this direction too.
Yeah, I mean, AI spending is starting to show up in GDP. So like, it's only a matter of time until people kind of catch on that this data center build out, Microsoft said they're going to spend 80 billion. Like the stock market will be supported. And I agree with Tom Lee. He's calling for 7,300 this year on the S&P. If that happened, that would really
No,
blow
no.
people away.
We're
And
at 7,300. We're at 6,000 right now.
right, we're 5,900. I think after the past couple of days. Keep in mind his
Yeah,
BTC
yeah.
call is also 250K.
Hmm.
We've talked about Tom Lee on the pod before, but he's just like I wouldn't even call him a permabull. I would just call him like a rationalist and a pragmatist. And I think he understands that technology is growing, but also the PE multiple kind of naturally increases over time as the money supply increases. So if that happens, people are going to be really shocked. And um, at 250K, people will be more bullish than they are today by probably an order of magnitude.
So, how does this translate into crypto? I'm pretty sympathetic to this idea that, I mean, AI is obviously much larger than crypto, and this might be crypto glomming on a little bit to the massive AI growth that's happening in at least the U.S. economy writ large. But the big meta that people are interested in right now are these agents, and and you're starting to see. I mean, what do you guys think about all these names? There's AI 16Z, which is kind of funny because it was like an investment club or on-chain DAO or whatever. And now I know there's Eliza and there's the whole open source sort of Rust-based framework for creating these agents. But, you're starting to see things, I don't want to name them because they're all super micro caps, but they're just regular companies with AI in the tickers. And I'm curious if,
And it comes to mind.
huh?
Long Island blockchain comes to mind if you
Yeah,
remember that.
yeah, I do remember that.
Look, I think anybody's going to latch onto this, but keep in mind, like the vast majority of the business of AI right now is businesses purchasing infrastructure to build out systems that will hopefully then productize and then be sold to customers eventually. This is
Right.
like the data center build out. This is like laying fiber. This is buying, H200s and the thing that Jensen just announced at CES this week. Like this is buying like hardware and infrastructure, getting access to data, paying electricity to be able to train these models. Like we're not even talking about the shift from training to inference of these models, which is like basically like development to use is how I would describe it. And so I think we're still in this like we are betting that AI is going to work, and that bet is so big that bet in terms of revenue dollars is showing up in GDP. Like that's basically what we're saying. So even if you are building out something in AI agent land or AI, or you've got crypto and AI in your name, like I think the future is highly potential that things will work. But I also think that it's going to take a really long time because even the Apples of the world or the open AIs of the world are still just barely scratching the surface in terms of what is the productization of this. Like we are very much in the inning analogy again. We're like we're in the preseason right now. Game hasn't even started yet.
Hmm. So I would say the general perception of AI and crypto is that everyone knows that it's a meme, just these new AI agents are the new meme coins, and that there's a pretty low expectation in terms of what they're actually going to be able to deliver on any sort of short or even midterm time horizon. Do you guys roughly agree with that? Are there use cases that you think might actually be more interesting than that? Or is it all just an infrastructure play and it's super early innings for this kind of AI crypto intersection?
I mean, relative to the Web 2 implementation of AI, I would say it's like pretty level footing. like everyone's still talking about, you're going to have your chat bot book your travel and call your hotel for you. And it's like, I think the problem is that like people just don't want to use chatbots. And like even, think about Sam Altman's most recent model announcement. It's like, yeah, we're breaking all the benchmarks. It's amazing, but it's going to be about $1,000 a query. So like there's kind of like obvious gaps in each industry in terms of like either the cost or the use case or just the relevancy to a larger market. But I think the market's going to be patient and kind of letting people sort out what exactly is AI and how it manifests. Like, do I think the current AI protocols are going to be the ones that win? I would say probably not. There's
Mm.
more talented people that are getting into the space, and specifically people from these AI labs starting crypto protocols on chain. I would expect those to do pretty well, but um, I would still say that AI on chain is probably the most interesting use case that people see within AI today. Like the other ones are very far afield. It's like we're going to have AI develop bio drugs, or we're going to have AI replace, like call centers. Like these things are great. They're just like probably 4 or 5 years away. So I think crypto is likely to have the most near term use cases for AI. And like, what are people tweeting about? They're tweeting about Truth Terminal. They're tweeting about Fartcoin. They're tweeting about all the stuff that AI has created on chain. As silly as it is today, it shows you probably where the money is going to go. And maybe that changes after the OpenAI IPO, but that will probably be a year or two away. Ditto Anthropic.
Hmm.
Yeah, longer Anthropic. I think, yeah, just to capstone this, we as an industry and as like a people who analyze the industry, far overestimate what's going to happen in the next 2 years and far underestimate what's going to happen in the next 10 years. And this is a classic example of that. Everybody's like, oh, in 2 years, we're going to have all this shit working on chain and we're going to be able to, it's like, no, like, yes, we'll get there, but it's going to be 4 years. Congratulations. And also, like, what you thought was going to take 10 years is also going to take 4 years. And like,
Hmm.
that's where we're at. And I think things will happen a lot faster, but the expectations around what the use cases are right now is going to take a lot longer.
Hmm. Do you think that there's okay, so I mean, I know you guys invested a good amount in gaming, and I'm much less familiar with the sector in general, but I sort of remember there was a little bit of a talent problem when it came to gaming, because a lot of the true gamers were like, oh, I don't want it. Like they viewed crypto from a very negative lens, and all the crypto people were confused. Like, why are you viewing it like that? And I wonder if it's the same in AI a little bit as well. Like, are the hardcore AI people? There's so much opportunity and money for you to make in Web 2 where it's considered more serious. And I wonder if there's a little bit of an analogy to be drawn there where kind of you might have almost adverse selection for the AI people that come to work in crypto. Do you think that's the case or no?
Well, once again, everybody who works in AI right now is in the like development and research mode.
Right.
Nobody is in the productization and distribution mode. When this
Mhm.
industry shifts to that, which is like happening slowly right now, but it'll happen increasingly more over the next year or three, we're going to start to see a lot more product focused people come into the industry and say, okay, well, how do I actually get distribution? Like, what are the actual use cases of this asset, of this technology, of this asset? And that I think is where crypto actually provides a unique angle for distribution. And you just mentioned something that I think is actually my base case for like what is the most interesting use case for crypto and AI right now, which actually is gaming. Like there is a really interesting confluence of you want to play a game, you want to have it be something where you're not just working against like what feels in the game like a computer that you're playing, like an NPC that you're playing. What if you had an intelligent player that you're playing against? What if you're instead of going to a marketplace and you're like, oh, here's the order board of all the things that I can buy in this game, I can go and like actually negotiate with an AI agent and have it be something that's a lot more engaging. What if I can use AI technology like a mid journey or any sort of content creation to actually build a game and reduce the cost by 10x of what it costs me to have the artwork and the creative and everything that goes into the game, and I can build a game a lot more cheaply. Like the gaming side of this, and historically games is one of the industries that has led in terms of new subcategories within internet technologies. I think AI is also going to be the same. Everybody is focused on chatbots because of ChatGPT, and that was the first thing. But I actually think gaming, especially when it comes to crypto, is going to be the first thing that happens from an AI integration perspective.
Mm. Are there examples that are, I sort of remember like Prime being an example of an early AI gaming intersection play or.
I mean, just like the permission structure in Silicon Valley is like you need talented founders to leave and start a company, and like that's already happening from these AI labs. So like the entrepreneurs have some respect, and then I think you need the VCs to be excited about, which like you have Chamath shilling like BitTensor, like you're there, and I think it's also a function of like
He showed
you know,
stablecoins too the other day.
right. I don't think he knows much about them, but he knows they exist.
He's just end of the month kind of guy.
But it's great though. You need him to give everyone permission to get in the pool.
Definitely.
And I think the
Definitely.
other thing is like it's a function of how large these AI companies are. Where you're early at OpenAI and it's a $10 billion startup. You're mogging the crypto people for being stupid because it's going to go to 150 billion. But at 150 billion, there's probably greener pastures in crypto in terms of just your ability to create value than staying at the OpenAIs of the world, which I think we're seeing already. And the last thing is like you're also seeing a lot of the AI startups hit a wall. A lot of them aren't working. A lot of them are looking for areas that have less platform risk, like crypto, versus just like being able to get shellacked by OpenAI. So there's a lot,
specifically the AI product startups.
right? Yeah.
Like the AI infrastructure startups are obviously doing well, and they're the ones that are going to power all the products. But I think this is also where like there's no bad ideas. I think in startup land, I think there's just bad timing. If you decided in 2023 you're going to quit your job and like go start a product that's based around in AI and basically focus on distribution and productization, I think you were probably 3 years too early.
Yeah, the timing just sucks. It's really hard to get right. So yeah,
We're not going to have a new crypto use case every year. Some years are going to be spent scaling the existing ones. Some years are going to be spent, with a breakout app that is new, but like it's not all going to happen in the same year. And if you think of the past 3 years, I think we've got AI games. I mean, DeFi scaling, meme coins. Like we are creating use cases quite quickly. I know everyone may not be excited about, like one or the other, but like the industry has a ton of breadth.
I completely agree. And I actually think the DeFi stuff is you can't just ship a new DeFi primitive every year or even every other year, but there's a lot of innovation there that's going on, which is highly interesting. We've talked about Morpho on this show and more modular based lending. There's kind of capital efficiency gains, like Fluid is an example of, more capital efficient structure between their lending pools and DEX. I think there's cool stuff going on, like Maker or Sky is crushing it. Like you just look at the amount of cash flow that they're generating, they're expanding into Solana. So there's big things that are going on. It's just not, it doesn't need to be a revolutionary new use case, every other
Prediction markets broke out last year. Like, I think it's just the attention span of crypto Twitter is so small and largely based around their ability to get rich or not off something that it kind of obscures a lot of the progress that's happening in crypto.
Yeah. It also feels like there's a lot of the crypto space is just much larger than it used to be, and there's way more dispersion. And I wonder if that's contributing a little bit to, I saw a lot of tweets this week saying, hey, everyone feels pretty exhausted going into this new year and this bull market and yada, yada. And I kind of understand that a little bit. It feels a little different to me than it has in the past when prices were up as much as they are off the lows. And I wonder if part of that is just that, you can't really just buy, the 5 or 6 biggest assets and do a 20x anymore, and you actually have to be a little bit more discerning. And there are people that are probably lost or not done very well as this market has done extremely well.
Keep in mind, where were we last equivalent in the cycle? Where we were was you literally had Dave Portnoy pulling Scrabble letters out of the bag and picking what stocks to buy. Like we're in a very different world now. But that was the mentality because everything asset wise was up and to the right because we were printing trillions of dollars of cash. And now, yes, you have to be discerning. You have to make the right choices. It's not as easy. It's not easy in general, but you have to also have a longer time horizon. And this whole like, let's get in the Discord and pump it, and like this micro cap and like that, those little mini games can work for a little while, but they run out of their energy very, very quickly. And so I think, we're going to move to a longer duration. You have to be, picking the right things and in the right things at the right time. You have to hold on to them longer. They have to have durable, sustainable value. Like this is just the industry maturing, in the with the backdrop of rates at 4.5+%. We're not printing trillions of dollars of cash, and a more sensible, growth oriented economy is on the horizon, but it's not here yet. It was just absolutely bonkers what was going on last time.
Yeah, it was. On this note, so there was an exchange that I saw crop up between Jesse from Base and Anatoly that I thought was interesting, and I would love to get your guys' take on. And it kind of has to do a little bit with this, like how much more new stuff do we need versus basically trying to get a sense of like the market size for this was specifically kind of like L1s and L2s, and this is Anatoly responding to someone named Millie on Twitter. And the quote is, seems logical, but it's also wrong. There's no point to multiple L2s. If a single L2 can handle parallel execution, then it can use up all the blob space and run every single use case. Skipping ahead a little bit, there are like only 6 major smart contracts that matter. And there just isn't a need for infinite developer optionality. And Jesse responded to this. As far as I can tell, this is one of the biggest philosophical differences between the Solana SVM and Ethereum plus EVM is the perspective on what we can and will build on chain with smart contracts. And basically, the EVM mindset here would be that we're just scratching the surface of the world computer, and there are infinite new contracts to be built. And obviously, this is really tough to ever fully know, but just kind of makes me think a little bit about what we were discussing before. That hey, we don't need a fantastic new primitive every single cycle, and the truth is there's probably some middle ground in between. There are only 6 smart contracts that are really worth writing versus there's infinite new smart contracts and kind of infinite possibilities. And we're going to bring every single thing on chain. And I would love to, without getting into like an Ethereum versus Solana debate or do we need L2s or whatever, I would just love to get a sense of kind of, I don't know, market sizing for interesting opportunities that you guys see out there right now.
This is the fundamental philosophical difference between we are going to build the NASDAQ for blockchains, where trading is the major use case. In Anatoly's world, you've got one smart contract for exchange and speculation and trading, basically NASDAQ, as one of the 6 main functions. Maybe like there's a payment smart contract, and then there's but it's like there are only a certain number of small use cases that blockchains are for. Whereas Jesse, on the other hand, is like, this is a new developer platform. We are going to have decentralized applications where there's tokens related to them. Look at Blackbird, look at Glow, look at all kinds of applications that are building novel, differentiated use cases. Obviously, way more than 6 of them, and it's just a total different philosophical approach. And so you don't have to be there. There isn't going to be anyone who's right or wrong right now, or at least until there's more than 6 extremely successful use cases. Then maybe Jesse's right. But I do think our perspective, just given that we are venture investors in this space, is fundamentally that there are more than 6 major use cases of what blockchain technology should be used for.
Yeah, I mean, I think it's a little self-serving to be like, we don't need any more chains beyond my chain. I think that's a little telling. It's also very like a scarcity mindset in terms of like your perspective on the industry and where it goes. I think we're still short block space. In the fullness of time, once we have 1 billion DAUs, there's no shot we have enough.
I mean, one like question would be, okay, what would be the counterpoint, or what would be like the proof point of one of these perspectives being correct? Is it time? Is it like the enablement of something? I mean, it seems like basically Toly saying, if it's not just NASDAQ and payments, like I don't know what other use cases make sense on blockchains.
I think that's roughly, I mean, this is Kyle Samani also doubled down on this as well. And, the multi-coin perspective on this is that blockchains are asset ledgers and they're really good for recording asset values and transferring asset values. But the use cases outside of that is a little bit limited. And I think maybe that is the perspective, right? I don't know.
I think we're still scratching the surface. Like the AI stuff, we have no idea how it's going to play out. The energy stuff, we have no idea how it's going to play out. It's not even launched. The gaming stuff is still subscale. Like, I don't know. You got to dream a little bit bigger if you think that, these things are just asset ledgers. I mean, that's a pretty bearish perspective.
So I also got to give a shout out to Jesse, who shaved his head this week. There was some.
Bald now.
He's bald. Yeah. Pulls it off. Looks pretty good. He's got a not a bad shaped head. So shout out to Jesse for actually delivering and live streaming the shaving on X.
Live stream it too. That's epic.
That's crazy. I didn't realize he live streamed it.
Yeah, I think it took a couple of different streams because Twitter kept cutting him off. But yeah, I tuned into the last one where I saw the last vestiges of his hair get shaved off. So yeah, definitely very good stuff. But I guess like final, I'm curious what you guys would think about something that's been getting talked about a little bit is, I mean, Robinhood and their involvement in crypto in general. And I think we might have talked about it a little bit on the predictions episode, but I don't know. I would be curious. Like Base has done extremely well, or Coinbase has done extremely well with their L2. Like if you just look at TVL, I think they've gone from 400 million to over 4 billion in TVL over the course of the last year. Actually, L2 Beat has actually they've changed their definition of TVL. It's just total value secured. It's just the number of assets that are actually on the chain, not necessarily locked up. That's a good move from L2 Beat, just making terminology consistent. But there's an enormous amount of assets that exist on Base. And they've been very successful in just taking a bunch of activity and volume and assets there. And I'd be curious, do you guys think that there's an opening for Robinhood to do something like that? They have an enormous amount of retail users. They have more daily active users actually than Coinbase, even though Coinbase has a larger total verified user base globally than Robinhood does. And I just kind of seems like if they were to lean into it, they could run a pretty similar playbook. They've got massive distributions. They could do something like maybe launch a stable coin. They could do something like create their own L2. I'd just be curious if you guys see that as an interesting possibility or no.
The L2 is probably the most logical one. The stable coins that are corporate branded have almost universally done pretty terribly. But I think there is something to, like, one of the main metrics that they advertise is like TVL on Robinhood. And they're specifically trying to make a push into wealth management. And I don't know if you've tried to, put your money into T-bills in a bank account or a CD. It's like next to impossible to actually figure it out. Those are things that on chain make a ton of sense and that are composable. And, Robinhood also has this borrowing feature where you have stocks and you have buying power. You could build that all on chain in a way that's probably way more efficient and way more capital effective than a traditional business. So like, I think this gets to the point of like, why do we need more block space? It's like, well, these companies are incentivized to sell additional products, block space being one of them. And if you can get all these people on chain, that's an incredibly sticky moat that you have.
The best indication of whether or not an L2 makes sense for Robinhood will be what Kraken and Inc. ends up doing. And I think Coinbase has pulled off one of the most difficult things to do, which is how do you transition a bunch of users who, frankly, in 2017, the vast majority of the tens of millions of people on Coinbase, I would imagine, I don't know this for sure, this is a yes, were in 2017 what I would call passive users. And what has happened over the last 5-6 years is those, and I guess now 8 years, is those passive users have started to get more and more active based off of the products that Coinbase has launched. Coinbase Wallet, the ability to stake, participate in new asset launches, and be able to do DeFi things in 2020 and 2021. That pulled the passivity into a more active role with Coinbase Wallet. And then it made very obvious sense that you were going to be able to move from Coinbase Wallet to Base, because all of those activities, all of those actions were going to happen on the L2 that was functioning on Base. What that did was you had the carrot on one end of all the verified Coinbase users using Coinbase Wallet, pulling assets into Base and pulling app developers into Base as well. That's what jump-started the flywheel. I think it's exceedingly difficult, if not impossible, for another basically like passive crypto product company to be able to do that. Like, period, full stop. I don't think Robinhood is going to be successful. I also don't think Kraken Inc. is going to be successful at all. And I think they will have an incentive to do it for sure. And it's in their board strategy. I'm sure they're going to be like, we need to do this because look at what Base is, and we have X number of users relative to them, and we could get X number of revenue dollars, like all that stuff. Everybody's going to try it, but I don't think you're going to be able to successfully transition your users from passive to active in the way that you would need to be able to have these L2s actually be fully functioning and sustainable. And so maybe the wealth management product is actually the better approach. because if you've got a bunch of passive users, like you just throw more product at them. Like you put T-bills on chain. Okay, great. We're going to have, the interface and just like make it super easy, mobile oriented for you to be able to one click buy T-bills on chain. And that's going to be their whole shtick. Or maybe it's going to be more creative products like a straddle strategy for whatever the interest rates are. Like you could add more products that makes Robinhood more interesting, but you're further cementing the fact that these are passive users. That's the way that I think about it.
Could also be as simple as like put all your users on chain, lend to them at 6%, and put it in Ethena or Maker at 10 to 20%.
Right.
A product that's only up possible on chain, that's facilitated by their access to traditional borrow, that makes a ton of sense for the users.
This is precisely what I mean, which is once we have regulatory clarity on what these assets are, you're going to have the ability from financial institutions and publicly traded companies, aka Goldman Sachs and Robinhood, to be able to put their customers' assets into things like DeFi. In some assets they won't be able to because it'll be an unregistered commodity, or like it'll have to be going through the registration process. But once certain of these platforms become registered and clarified, like the head of digital assets at Goldman Sachs is basically, he said in a quote, he's like, we are ready to go. We are waiting for regulatory clarity so that we can get all of our assets and client assets into the DeFi ecosystems and use them in productive ways. Like that's, I think, where things need to go. And then you take care of the entire, millennial generation and their financial management. You have unique opportunities in DeFi. And if you're the first there, like that's the productization differentiation that builds the moat for Robinhood users.
What do you guys think about Ethena in general? We haven't really talked about them. They've been, I think they're the fastest stablecoin, or they don't define themselves as a stablecoin, but whatever, close enough to get to 5 billion in supply. And yeah, the yields that they're able to generate are pretty massive. And I don't really remember watching, relatively new protocol become so integral to DeFi so quickly. And I don't know how much you guys have paid attention, but and I would assume a little bit because they've tied up a little bit with Sky. And I think I saw that USDE is moving into the backing for USDS moving forward. And so I'd just be curious, like what your guys' thoughts are on Ethena, the sort of rapid growth that they've had, the yields that they're able to generate, all that good stuff.
It's very impressive.
Very impressive. I mean, crypto yields across the board right now are super high. Like Sky is at 12.5. I think Athena's maybe 15 or 20. I think there is some question as to like, is this extractive from the ecosystem? Probably in some ways, yes, but also like you're financing longs. So I think there is the argument that like you're lowering the cost of capital for crypto native participants. But it's super impressive. And I think it's just a testament to like stablecoins being a primitive that you can grow extraordinarily fast if you are doing it in the right way. But there's so many that have done it in the wrong way, like PYUSD. Like no one wants a payment stablecoin; they want a yield stablecoin. And I think that's kind of the underline here is like there's a lot of sideline capital that wants exposure to yields, and if they continue to go down, if the Fed keeps cutting, it's only going to continue to grow. Where Robinhood can lend at 5 and then put it in Ethena at 15. That would be very, very interesting.
Yeah, very impressive, the mechanism that they've designed, the scale that they've gotten to. I think what's been most impressive as of late is their business development strategy. Every single stablecoin that's dropped into Boyco for Bearchain is actually swapped into USDE as well. They're backing Maker. Like they've just hit all of the zeitgeist initiatives within DeFi that put USDE everywhere that it should be. And so they can keep that up. I think they're going to be, platform ubiquitous. But I do think what will be very interesting is let's assume that the interest rates start to come down. That 4.5% gets down to like 2.5%, 3%, whatever it may be. Does the yield on Ethena actually follow that? I don't think so, just given the fact that it's funding rates. And so as the separation between like the natural risk-free rate and USDE rate starts to separate, I think that's actually where they start to gain more ground. And it becomes an even more attractive proposition just because, you can earn 12, 13, 14, 15% if we get into a crazy bull market and funding rates pop, like it could be, back to the 25% plus rates that they were getting before at smaller scale. And if you're doing that at a massive scale, like there's real potential here for this to be a differentiating factor within DeFi and getting access to it. I mean, once again, this is like, if you're a Robinhood user and you're like, hey, I can earn 2.5% treasury yields in 50 years with, $10 million, I'll be able to buy a house in Napa that I can't insure. But if I have, USDE and it's earning 17, 18, 19, 20%, like that's a fundamentally different proposition. And if it's just cash on Robinhood and I'm able to choose between the two, like that is the product that I think Robinhood would absolutely crush with.
Keep in mind their whole like future strategy is wealth management. So, I mean, what better product to offer your wealth management clients than a 20% yield, risk free?
Yeah, you're right that it should be at least the Ethena yield or USDE yield should be almost inversely correlated with interest rates. And yeah, frankly, it's super cool. And those and the rates that Ethena is able to generate bleed over into the rest of DeFi, right? Like as USDE starts to back USDS, then those yields get passed on to,
Yeah, there's a free rate, which is U.S. Treasury yield, 10-year, maybe we could call it that. Then there is a reference rate, let's call it within DeFi, which is not risk free. Like USDE, Athena, absolutely not risk free. I remember, I think in April when I think there was like the first attack from Israel, and it was like, oh shit, is this thing going to blow up? And it was one of their first tests, and everything was obviously fine, but there is risk involved, obviously, with making sure that that is clear. But this becomes the backstopping rate, the reference rate for most of DeFi.
Do you remember when people used to call 20% the risk-free rate in crypto because you could dump stables into Anchor and get 20%?
Bro, speaking of, our boy is in the US and it looks like he's getting investigated.
We've got 12 months to wait until his jury trial starts.
Yeah, maybe just something to leave this on is like, I mean, we started with this, but like last time the yields in dollar were at this rate, crypto was a fourth of the value. It's a testament to the strength of the crypto, the strength of the ETF flows, and frankly, just how much juice is left in the system to just goose risk assets. It's going to happen, but you need to see that turn. And I think, look, Scott Bessent, Trump, Jay Powell, I think they're all singing from the same hymn book. So you just need to wait for that. And I do think, to get to the fire points that we're making, the higher the carrying cost, the lower the price of the asset. We're seeing that in crypto today.
It would be more concerning, right, if we were going into this new year and everyone was pricing in a strategic Bitcoin reserve and rates were already at rock bottom and all of that stuff. But there's definitely more gas in the tank. I agree. So
no, this is my point. The market over the last, 3 weeks since the FOMC meeting has basically de-risked all of the positive upside potential. Now all we've got is upside potential because it's all been put into the market. And oh, by the way, we're only at 94, 95K.
Yeah. All right. That feels like as good of a place as any to leave it. Fellas, this was a good one. Nice first roundup of the year, and see you here at the same time next week.
Peace.